Good afternoon again, guys, and welcome to another one of our continuing the series of how we use previous week's data to plan for the next week. So usually starting with the daily chart. Same pair, GBP USD. I did plan to include other pairs, but trying to keep the videos at a particular length. I'm not going to start that just yet, but I will be including more pairs in the future. So let's get in. So as usual, go ahead and pause, analyze GBP USD daily chart, and then take a look at what we have. Okay, so last week we're looking at the range from this high to this low, and in particular, we had outlined that 1.36 had a whole lot of liquidity resting below there. So the anticipation was that another round of selling was likely to happen. As usual, the week starts at this arrow. So this is what we were working with last week. My anticipation was that we would use this down candle here as a bullish order block, see price trade higher before selling off. This order block was where my eyes were looking for the next round of selling to happen. We didn't get that high. We got only back into that old low from the previous week or the week before. The level we're looking at last week, when you drop the hourly chart, you'll see it. We got as high as that, and then we broke down aggressively. Took 1.36, took 1.35. I think it went as low as whatever low is on this candle, which is 1.341111. So on a higher time frame, if you're looking at just the big figure, mid figure levels, you'd have 1.36, then 1.355, then 1.35, then 1.345, then 1.34, and so on and so on. When you drop to a lower time frame, you'll see why I looked at 1.345 and why it's outlined on this chart. So we did get that sell-off happening. On a lower time frame, it will be clear to see why this selling opportunity was pretty evident, and even though it didn't get to where I wanted it to go, I was okay with this happening. And turned out to be a good trade. I didn't get all of that. Small portion, but again, I'm not a swing trader, and I generally don't hold for this huge moves. So we dropped the hourly chart. You guys have seen this before. Nothing to explain here. So what you can do is go ahead and look at what we had last week. Look at what happened this week. Just pause the video, analyze, and then when you press play, I'll add some more annotations. All right, so here we are. So this was the last week's range from the order block at the previous week's low. And we did highlight that this was one of those times when the retail idea of support broken becomes resistant was very nice. So this level up here was, let's call that resistance, and then price dropped. When we dropped here, what we notice is that there's a short-term low created here, and price traded back inside or very close to this resistance area, and then it broke down and took this low. So in terms of market structure, we have a high, a low, lower high, and now a lower low. So you're not wrong, or it wouldn't be wrong to say that this market is now bearish. If the market is now bearish at this price level right here, what we'd be looking for is what's the range of price is currently trading in, and where are the bearish order blocks that we could get in at, right? So I'm not using this high because that's where the reaction happened, and I wasn't bearish right there. When it broke this low, that's when bearish momentum come in the market. Based on how I understand it. I could be wrong, but based on how I understand it, I have a low being taken here. Price drops. Market is bearish. But once it drops here and your anticipation is that the market is bearish, before you get confirmation, you have to see the market trade back to like a bearish order block and then not violate it. That's when you start entertaining bearish ideas. Anything outside of that, then you're likely guessing. And guessing will be correct only so many times and no more. This red line right here is currently outlining this order block here. And I'm using this order block because this drop from here to here, when it took out this low, that's when I would be bearish, or I would be considering the market being bearish. So since this is the last up candle before the drop, based on ICT's definition of an order block, that's the first one that would come to mind. All right. So we'll highlight that. When it drops here, formed a low right there. So highlight from this high to this low as your current trading range. If that's my current trading range, then I want the high and I want the low of that range. That's it. Price trades up into the range, reacts off the bearish order block here, and then drops. So then now I would be interested in risking money on this trade if I was trading. I'm not a financial advisor, so I'm not advising anybody to put any real money on this, but feel free to practice in your demo accounts. So right here is where it reacts off the order block. Have a nice drop there, forms another order block there. So I'd be looking at this one first for entries. So here, that's your entry. Stops above here, stops above this if you want to be extra careful, because this is the high of the range, then you're fine. Price explodes lower. Gets to 1.36 first, 1.365, and it breaks down. And I'll tell you what all this boxes and lines means. So the questions we got in the Telegram channel were primarily around outlining the range and liquidities as it relate, or liquidity levels rather, as it relates to the range. So liquidity levels inside the range, liquidity levels outside the range. So internal range liquidity and external range liquidity. The definition is pretty straightforward. Internal range liquidity would be liquidity levels inside of a known range or a defined range. External range liquidity would be liquidity levels outside of the trading range that you're currently trading in. So if we're inside this range, from here to here, internal range liquidity would be any levels in here that you could identify where persons would have their stop losses placed, and that's your internal range liquidity. External range liquidity now would be all price levels outside of this range where obvious liquidity is being held. So that's when you could use like a higher time frame chart to identify like an old low and any other levels that you could use to reasonably say that stops are resting here, right? So if we're seeing this range being created here, and we have reason to believe that this market is bearish, and we were bearish, or I was bearish coming into the week that this was going to sell off. I wanted to see it trade higher and sell off. What's important to note about that is, even though last week I said I'm anticipating heavy selling, I outlined that I wanted to see price trade higher first into the order block and then sell off, right? So when this happened, admittedly I wasn't at my charts. I just got a piece of this. So talked about internal range liquidity, external range liquidity, and that's fine. Defining the range now is what we did here, where this order block starts the push, that break structure. So from there to wherever it stops is your range. If it breaks that low, then obviously you drop the line again and you have a low for your range. If it comes back in the range and it breaks the range, so let's say this broke through this range high, this would still be my range. And I look at whatever trading higher up here as turtle soup. And even though it didn't happen here, because this level was previously used as quote unquote resistance, it wouldn't be far-fetched to think that price trading back up in here would also be a good area to sell it. But we didn't get that. So yeah. Now the next question I got was standard deviations. To simply put, or to put it simply, standard deviations are just projections of a range. So this range from this high to this low, that's a range. If I wanted to project that range, I could simply measure the range, and then let's say this is 10 pips. I measure 10 pips from the low. That's one standard deviation. Then I measure 10 pips from right there down again. That's 2 deviations. So that's the basic idea. To put it visually on a chart, almost everybody I know, and that's how we learned it as well. We use like a box, put a box around the range, then we copy the box and then attach it to the end, and then all of that, right? So this has already been done, but let's say I wanted to find 1 deviation above this range. I'd simply grab that box, phone it, and put it up there. And then if I was anticipating a 1 deviation push higher, I'd be looking for inches in here, right? So it's a general idea. Now I'll talk about why I had 1.345 outlined here. Generally, when you're trading, the ideal setups are where risk to reward is framed around a 3-to-1, right? So if this is the range, 1 deviation higher, 3 deviations of profit. So my stops would be 1 deviation higher, and then my target is 3 deviations down. So because of that notion, I always default from the first time I learned this idea to using 3 deviations of a range. All right. So what I did was 1, 2, 3 deviations down got me to this price level, which was 1.342. Then I started matching big figure, mid figure levels. So 1.365 was the closest level to this low. So then down further would be 1.36 and 1.355, then 1.35, then 1.345, which is what that's here. 3 deviations got me a little bit below 1.355, and that's fine. A 2-to-1 trade is also good. So I always note 2-to-1 levels and 3-to-1 levels. And then if we get more, then we just get more. But generally, on an hourly chart, ranges can be like 50 pips. So 2 deviations of a 50 pip range, that's a 100 pip target. So this line and this line is my 2 deviations line and my 3 deviations line. Now, luckily, coincidentally, or maybe this is what happens, price trades down to 3 deviations of the range. It should have been right there. And then it stops and then it retraces inside the range. So now the range would be in here. So you could fib this range. You fib this range and naturally, you look for your arrays. And if we're looking for a continuation move down, use the same idea as we used here. So internal range liquidity for price to trade higher, and then what are the levels below the range low where liquidity could be housed. So maybe for those levels, you might have to go zoom out to a higher time frame, daily, weekly, monthly, whichever levels you're comfortable with. Identify where liquidity is likely being held and use that as your external range. And then from here to here, the levels inside here would be where your internal range liquidity would be resting. So hopefully that clears up that idea. I think I answered all the questions. And that's going to be it for this one. Join us again next week, and we'll review again.